The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Thank you for being with us today at the end of the first quarter. How's the volume, folks? Can you hear me all right? Just type in the question box, please, if you can hear me. See who's going to be first in. Chris. Good on you, Chris. Okay. Chris is on the ball. He's becoming a very, very good trader. He's just working his way through his tutorial. Yes, Suatsini too also, thank you. Okay, so you can all hear it. Folks, interesting, isn't it? It's just been a fantastic quarter of trading. And here we are now at pretty close to the end of March. I want to wish you all a peaceful and safe Easter in Australia, where I am. The globe turns a bit faster, and it's actually 10:31 on Good Friday down here, so we're already into Easter. But for most of you in America, this is Thursday evening, so good morning also to the Australian, and afternoon to our Kiwis who are with us today. Good crowd. Apparently not everyone goes away for Easter. Akshay, good to have you with us. He's a very long-term Daniel Code guy. Alan, who was a tutorial guy in New Zealand, responsible for us coming to this part of the world. Talai, Albert, Alex, good to have you. Chris, of course, I've mentioned. Oh, good. Harold's with us. Harold, Easter for you, my friend, up in Reading. I'm sure you'll be contemplating and then celebrating in the right order. Janet, lovely to have you with us. Nice to have ladies. We don't have many. We'd like to have more. Jay and John L. down in Coffs Harbour. We tried to get together over Christmas, John, didn't we? And couldn't make it. Manish, he's a tutorial graduate over in India. Manish, nice to have you with us. Ungodly hour where you are, I know. Mark, he's a tutorial guy, going to be a very, very good trader. Mick D, he's in the end of doing a tutorial. Old friend of mine, actually. Michael Pell. Michael, nice to know you're with us. You're very regular here. Whatever part of the world you're in, we wish you well. He's a guy who moves around about. Mike O, the big O, good to have you here. Pete, Philip, oh, look, everyone's here. All the regulars, great to have you with us, folks. And Sue, up in Cairns, I hope it's drying out a bit up there. I know it's been a bit grim at times. And Tom, our friendly wealth manager from Florida. Doesn't like me to say he's a hedge fund guy. They're wealth managers. Very, very good people. Tom's a great supporter of ours. Okay, let's move on. Been kind of interesting, hasn't it? We've had this huge growth in volatility that's upset so many people, including almost all the hedge funds lost money on the big fallout from the VIX blow-up, which is kind of weird. You wonder why. I mean, I'm going to explain to you why those things happen to them, and it's their methodology of trading. Anyway, let's move on. As we say, markets are rational, orderly, and sometimes predictable. We should have some changing charts here for you. And this one has the S&P on top and the VIX at the bottom. And you can see what's triggered all of the drama back in February. The VIX just exploded up near 50 on some days. Pretty good stuff. And of course, there's a massive investment in futures, in options rather, on the VIX index. And there's a whole lot of associated markets that are ETFs, ETNs, all the derivatives you can think of. What's reported is that they're all on the side of continued low volatility. So when the volatility increased and the market took a bit of a swoon, all of those people who were on the wrong side of the market lost their money. And of course, the biggest problem we face these days, not only in our trading, but in our everyday lives, is, in my view, the establishment and growth of 24-hour media cycles. So all of the media, from newspapers to radio, television, there seem to just be an endless supply of them. are running on this constant coverage 24-hour cycle. And the reality is there's not that much news, real news, happening day by day by day. So they start getting focused on anything pretty much they can talk about or write about. And that's why social issues are just so predominant, particularly in the United States. I read 3 or 4 American papers every day, and this obsession with culture, I don't get it. But then again, I'm an Australian, so I guess that's understandable, but it is really very, very strange. So, of course, this nice big plunge that we had in February, which was just perfect for us in our trading, was all promoted as, the millions, hundreds of millions, maybe billions of dollars lost. The reality is, for every one of these market instruments, there's someone on the other side of them, whether they're futures or options. There's someone on the other side. All trading is nearly a zero-sum game. Some lose, some win, and the brokers are the rats who just clip the ticket whenever it appears before them. So just as many people made a lot of money on that little swoon by the market as those who lost money. But you never hear that, you never see that written. But this I've noticed lately we've had with anxiety comes indecision, and this chart that you're looking at now gives you the absolute perfect view of how that happened. As you get great volatility, if you're not a particularly good trader or not seasoned enough, it gets very panicky because the markets are moving in huge waves, and if you're on the wrong side, you're going to be killed. But as well as that, look at the size of these bars. This is S&P from about the beginning of the year. An average daily bar in the S&P is about $1,000. That's about the average daily bar. So your normal daily entries, you've got a risk of around $1,000 if you're trading the way that I trade. All of a sudden, you're facing bars that have got potential stop if you have to trade them of $8,000, $5,000, $2.5, $37.50. So how do you trade those? Well, you trade them exactly the same, but you put on a fixed dollar stop equal to the normal average range of your trading. You can't be buying and selling these big bars with your stop in the normal place, and that realization, if you have it, and the intention to keep your risk constant is essential to building your equity portfolio. You get into one of these big moves and your stop's in the wrong place, the damage you do is indescribable, and that's what's causing a lot of the indecision. I particularly was talking about this bar here. I'll just bring up the chart. Here it is. It's this bar here is Friday last week, March the 23rd. I had a ton of buy signals for all of the equities markets, and it was a real struggle to say, should I post these? Because look at the risk, 35.75 is the normal risk on this entry if you had your stop below the previous low, which you couldn't do. So you can get rid of all of that worry and doubt. Just say to yourself, I'm going to put on a fixed dollar stop equal to about my normal stop, in this case be about $1,100. Or if this stuff is frightening you, you don't have to trade these markets. There's a ton of markets to trade. Most of them are trending pretty well, showing a fair bit of up and down type volatility, and you can just stand aside. I stood aside from the S&P for a long time in the run up to its high, because I just found that sort of constant price action all one way. I found it boring. So anyway, there's the clue to it. But you don't have to suffer indecision, because I'm going to show you during today, markets are never traded better. The more volatility we get, the more accurate the Daniel code is. They've just been hitting the numbers, all of you who are members, and look at your members' charts. It's just been banging the numbers. It's terrific. Okay, let's look at this 666. I've spoken to you about this before, and I talked about it in a webinar a few weeks ago. And I brought some of these slides back for you because I think this is very important, this number. Some of you will know the S&P bottomed in March 2009 at 666 on the index. And this is a very important number. It's a biblical number. And it's the number of the beast. I've written about this before. But look how this number keeps showing up. There's this is the number of the beast in the S&P. There's the March low, 666. And this is how it's appeared in the Dow. 4 bars after the high, the Dow had a day, it was 666 down. Now have a look what's happening on time. We can take 666 from a significant low that was more than one standard deviation from the mean. That's our test for starting a count. Any high or any low that's more than one standard deviation from the mean. And that's a Daniel code standard deviation. That's not your normal mathematical standard deviation. The normal one does nothing. You have to use one of the Daniel code ratios to find your deviation from the mean. So this is, I've shown you this before if you hadn't seen it before. This is 333 times 2. So it's how we get to the 666 into the high from the February the 5th, 2014 low. Pretty extraordinary to think that count has been going for pretty close now to 4 years. And it's given us exactly the high in the S&P index. I've shown you this before. This is where the high came. It was at 3 standard deviations from the mean, and don't worry about anything else. Markets can't live there for very long. You don't need to fill your head with all the problems about trade wars, Trump's personal life. I mean, I find that extraordinary that the biggest audience comes from an interview from some woman he had a liaison with 10 years ago. I mean, what does it matter? It's a matter between him and his wife. What the hell's it got to do with the rest of us? But it's just flogged and flogged and flogged and flogged. I mean, it's extraordinary. The degree of obsessiveness there is about, not the first time it's happened in the world, is it, folks? Anyway, let's move on. This was where the turn came. I've been showing you the 12-day chart periodically. And we had a number of 2883 there, and it finished up making its turn 11 points off that. Not bad for a very long-term chart. This is another one of those weird things that you've got in December last year, in fact, December 2015 is that date. You've got a low that's more than one standard deviation from the mean. Running from that, you had your 666 trading days. This is an entirely different cycle count that did nothing, but then add a half. And why would we add a half? It's because the archangel said to Daniel, I swear by him that liveth forever that it shall be for times and an half. And at the 666 plus and half, which is in fact, this is a 6-day chart, so 111. Measurement on this chart is 666 trading days. Add and half, there's your high. Extraordinary stuff, isn't it? T-bonds, this again, long-term chart in T-bonds. I wanted to show you this because you've seen it many times. You should keep seeing it more, I hope. See that the little turn we've just had. Now, this is a 24-day chart. That's equivalent to a monthly chart. That's the Daniel Code's version of a monthly chart. All of our time frames are worked out on 6 and multiples of 6. So this is the equivalent, if you like, of a monthly chart. And this low was made in the period ending March the 12th this year. And that's made the low, which is exactly at that 148. I'll put the cursor there and hope you can see it. Exactly at that 148 daily time cycle. Now, that cycle itself actually starts back in the period ended April the 27th, 2004. Okay, so I want you to think about that a little bit. 14 years ago started a time count that's given us the latest turn in this huge, massive US T-bonds market. I mean, you can't trade it. The 24-day chart, the risk on entry is far too big to trade, but we get all the trades off the daily signals anyway. But the fact that a wave count or a time cycle count that started back in 2000, and make sure I've got my cursor on the right bar there, I don't want to mislead you, here it is, April the 27th, 2004 is when that time cycle begins. And now it's at 148, which is actually 59 times 2.5. Same thing, 59 is times, so 118 is times, and 148 is times and then half. Exactly the same thing, it just repeats over and over and over again, and it's quite extraordinary. So have a look at this big argument about interest rates. These are much longer term rates, of course, but they still dominate the funding from the Fed. What have we got? Well, we're below the mean. This is, remember, the T-bonds chart is the opposite of effective interest rates. In other words, this market going up, going higher means lower interest rates. This market going lower means higher interest rates. But they're not significantly higher. Look what's happened. They've come down. They're one standard deviation below the mean. And if you cast your eyes back, it's been there many, many times. That's a very, very comfortable place for it. So they're a bit higher than they have been, but it's not significant, folks, by any means. But the bond guys are very temperamental about this stuff. Let's move on. Here's the S&P. Some of you have seen parts of this chart. I brought it up to date for you. And the point I'm trying to make is, despite all the drama, I mean, you can't pick up a paper or a financial site without having the latest prognostications of doom and gloom. Today, it's the chief economist from Saxo Bank. I mean, the problem with that sort of commentary is it never tells you when. So he's saying that the S&P is vulnerable to a 30 to 40% downside move because mortgage debt is high. It's been building all the time since 2009. Consumer debt is high. It's been building all the time since 2009. There's rumblings for trade war. Well, so far it's a powder puff. There's nothing really significant about it at all. A little bit of tweaking, a little bit of renegotiation. And all of a sudden, he says his clients are fully invested. They've been fully invested for the last 3 years. I mean, none of this is new, but I don't know, these guys just have a brain flash, or they say, well, I haven't been in the news enough. I'll say something outrageous. And yes, the S&P's liable to have a 30% pullback. Any market can have a 30% pullback. But if you're going to tell us if that's going to happen, give us a signal and tell us when. If you can't tell us that, it's really not a lot of news, because you're just stating a generic obviousness about all markets. All markets are eligible for substantial pullbacks. Vicky's joined us. Vicky, lovely to have you with us. Another lady. God, we're doing good today. Look, we've got 3 here. And Terry as well, down from Upper Melbourne. Nice to have you with us, Terry. I haven't seen you with us for a while. Hope you're happy and well. Sean's arrived. Robert's. Yeah, lots of people coming in. Okay, well, I might have been a bit quick starting today. People have been a bit delayed, but we've got a good roll up now. Nice to have you with us, folks, all of you. Have a look at this chart here. We had the high came at a 4th seal line. Let's get to that chart. Here we are. That was... I've got enough data in this chart. Let me scrunch it up. Of course, we've had a contract rollover in there, but we're talking about, we had sell signals January 28th, 26th and 29th, TO3 sells, blue line sells in correlated markets, remember to think about correlated markets. Not all of these markets set themselves up perfectly every day. Often you'll find that you get a signal in one of these correlated markets, but not in the others. And the point about knowing about correlations, the most predominant ones of which are gold and silver and the Huey index, those three are correlated, and all of the equities, Dow, Nasdaq, S&P, Russell, and Germany's DAX, they're also highly correlated, that a signal in one can be used in any other. In other words, if you're trading the S&P, don't just be looking for S&P signals, be looking for signals in any one of those correlated markets, because if you get a signal in any of those markets, it can be traded in any other so long as the trade is elected. In other words, if you're buying, it's got to go above the 2 ticks above the high of the true high of the setup bar. If you're selling, it's got to get to 2 ticks below. Hello, Kevin. How are you? Traveling for the Easter holiday. Good on you, mate. You got here anyway. Good to have you with us. So look for signals in correlated markets. I've actually put together a little chart to show you the importance of that, because I'm not sure that everyone appreciates how important correlated markets are. Some people call that D2 or derived data. It seems to me simpler to just say these markets are so highly correlated that a signal in one can be executed in any of the others so long as they are elected. Okay, so this is showing you, or should be showing you, how perfectly and utterly normal all of this high volatility trading is. We had the sell signal right where we expected it against the Daniel Code blue line. Down it dashed to a black line, a red line on some other chart, but a big black line on this chart. That's the last level of support and resistance for that swing, the operating swing. We had perfect DC recognition on the close of the two bars that have got the arrows on it. I've taken off those numbers because it was getting a bit too busy, but it was absolutely perfect target recognition on the close. Remember, you can have target recognition in the Daniel Code on either the bar high, low, or on the close. Both are valid. Very important to remember that. You then had your high, your next high came exactly on the fifth seal line, which was March the 12th, and down it went, and it's been finding support around that 2600 replacement. 2581 was one of the blue lines. This is a slightly different version, and it's held that for 4 or 5 days. I suspect next week, folks, I suspect we're going to have a break of these lows. I think the market makers have done a sterling job sending everyone home for the Easter break reasonably happy, but I suspect that it's got to go lower than this and at least test the old lows again. If it breaks the old lows, then that's going to be an entirely different signal. But we'll deal with those as they come. You can see from here, or you will see, we hardly ever miss a signal. So you don't have to be concerned. Just follow the signals and just recognize when you're in a period of enhanced volatility. Use a fixed dollar stop equal to your normal risk. Don't go changing your risk. Or if you're not happy with that, stand aside and trade other markets. There are plenty of others to do. Interesting thing, just looking at these basic Daniel Code time cycles on the run-up of the red line. That's this fellow right here that you can see. That's the first of them. That's the 44, and he came in just one bar before the swing high. These time cycles are accurate to plus or minus 1 period. So that's accurate there at the 44. And then look what's happened as it's moved on. The 62 has come on the March the 13th, and that actually is the chart high of the move exactly. And the 70 is what stopped the run down on March the 23rd. So at a known Daniel Code number, at a known Daniel Code price cycle, time and price are squared, means a turn is almost inevitable. What I'm trying to get across to you is that markets in this volatile period are trading absolutely normally, absolutely perfectly. They're hitting their Daniel code numbers with precision and turning. They're hitting their Daniel code time cycles with precision and turning. In other words, these volatile markets, the equities that have got the volatility in them, are trading completely and absolutely normally. You just don't have to be frightened of them. All you have to do is make sure that you're managing your risk correctly. Okay, let's move on. So, you look at a chart with nothing on it, which is unfortunately is what some people have. If you don't have Daniel code numbers to guide you and signals, you look at the chart and you say, well, which way is it going and how far is it going? And you just don't have any metrics to measure it by. Looking at a naked chart like this is a pretty scary thing, because you just haven't put any running reins on it. You don't just know what's going to happen and where. So that's when indecision comes in, and that has one or two consequences. Either you'll be too brave and foolhardy and do yourself some damage, or you'll be frozen with fear, in which case hopefully you'll just stand aside. And if you want to stand aside when volatility increases, that's fine. For the better traders, that's what we're waiting for now. That's a bit of a cleft stick, because the last 3 months, you look at the hedge fund reports, the last 3 months leading up to the big VIX-related sell-off in January, all the hedges are saying, oh, well, we can't make any money because there's no volatility. We're waiting for volatility, something I'm saying all the time. We, as futures traders, we love chaos. We love volatility. It's what we live for. That's what supercharges your profits. But of course, the hedge fund guys saying they couldn't make money, they needed more volatility. When they got the volatility, this will surprise you because it surprised me, almost all hedge funds lost money in February with those big push down. In other words, they weren't hedged, or they weren't properly hedged, and almost all hedge funds lost money. We didn't, of course. We made a mod. So have a close look at this chart, folks. This is what I've been talking to you about with correlated signals. So we'll just go through them. We'll start the first one. We had a TO3 and blue line sell right at the high against that 2878 blue line number. Then the sell-off started, down it went, and at the low we had a correlated blue line buy in DAX, in Germany's DAX. The signal came from the DAX to give us a buy. Up it went, and then 2 days later we had a sell in the Dow. Again, the Dow is so correlated with all of these equities markets that if you have a signal in one, you can take it in any other. I didn't put in the next buy signal because the risk is just so huge. And as it rallied up, we got a correlated sells in both the Dow and the DAX for the next high, which is this little rally high right here. And that's going to be the truncated one. That is actually February the 16th. And it 3 days down, went back up. And we didn't get a sell signal at the high here. We actually had time sell signals in there. Down it went. We've got the ultimate high. We've got a daily buy to push it back up, and a correlated TO3 sell in the DAX at the rally high on March the 12th, all the way down. Then we had TO3 buy signals for Dow, DAX, Russell, S&P, and NASDAQ, all of them at the recent low. So the signals are fine. The signals are working. You don't have to have indecision. Take the signals, execute them with the appropriate, your normal dollar stop loss if it's outside your trading range, or if you don't want to do that, step aside from these equity markets and trade. I mean, commodities trading has just been absolutely fantastic. All trading's been great this quarter, but the commodities are quite outstanding. Okay, let's move on. Yeah, have a look at this. This is a pretty telling thing. This is the rally. The chart on the left, the S&P. The chart on the right, as you look at the screen, is the NASDAQ. When the S&P was making that rally up, which stopped at the red line retracement on the high of the first part of the rally and absolutely nailed the close of the final part of the rally, look what the Nasdaq was doing. It was making new highs. And this is a real sign of market weakness when you have, it's called non-confirmation. One of the correlated markets is making a new high, the other, or some of the other correlated markets are not. That's a form of long-term divergence, and you keep an eye on those sorts of things because they're happening quite frequently. And that was a very good argument as to why you get another down leg in these markets. Okay, let's see what we've got here. I want to show you this dollar chart. You've seen it a number of times. It's finally found support at the 88.34 red line. It's been there now for 1, 2, 3, 4, 5, 6, 7, 8 bars, and this is a 6-day chart, so that's 48 trading days. It's about a little bit more than 2 months. But the weak dollar is US policy, okay? Don't kid yourself that this stuff happens by accident. Steve Mnuchin, your treasurer, who's a very, very competent Goldman Sachs executive in a previous life, and a producer of some interesting films, including American Sniper, he has let slip a couple of times that the weak dollar is US policy. Well, what's the point of that? The whole of the Trump administration is driven by trying to make things better for business, in the belief, and it's not like the Liberal Party, or what we call the Liberal Party. It's actually the Conservative Party in Australia calls itself the Liberal Party. There's nothing liberal about them. They are dedicated to promotion of big business. So Trump is also, and his administration are also very much committed to the promotion of big business, but they are doing that in the belief that the healthier big businesses, the trickle-down effects will be strength throughout the economy, more jobs and better jobs. And there's considerable evidence that that is actually happening right at the moment. But this weak dollar policy helps American manufacturers, because having a weaker dollar makes your exports cheaper to the world in terms of other currencies. A weak dollar makes your exports appear cheaper, therefore more competitive, and au contraire, it makes the imports more expensive, which mitigates in favor of production as opposed to imports. That's a very, very broad expansion discussion, and it doesn't happen at the margins. It has to have quite a big effect, but that's why there's a weak dollar policy. And there's no guarantee that this is as low as it's going to go. It's quite possible we get another leg down to 85 or thereabouts. And that wouldn't be the end of the world. You can see for most of 13, 14, it was down around the 80 cents or a bit less. So keep that in mind, because what that means for all of any assets you're holding in the US dollar, you're losing money. And this chart shows you, this is the long-term 6-day chart of the S&P. If you take the value that's been lost from the depreciation of the dollar, the true value in adjusted US dollar terms of the S&P is 23.21. I know that's there are other ways of doing the calculation, but to put that in perspective, the market closed today at 26.37, and the adjusted dollar adjusted value of it is 300 points lower. So that's what it's really worth to you if you ever have to buy overseas assets or go overseas. So I know the vast majority of you are not concerned with that, but these currencies do count, and these exchange rates on the different currencies. The US dollar index has a basket of currencies that it's ranked against. You can do the same calculation with all the different currencies and get different results. So don't fret about it, but something to be aware of, that if you're holding only US dollar assets, they are depreciating fairly significantly. Okay, later this quarter, probably not far away, probably as soon as a week or 10 days away, we're going to start testing a new program that we've been working on for over 2 years, and that's to put the time trading signals into a computer program. Now, if you look at this chart, you can see this is gold, which had a nice big run up right at the beginning of the year, end of last year, and has been pretty much sideways since then, but at least it's having good vertical movement up and down, up and down, up and down. These are what we call the every bar, or the everyday signals. And the big difference between trading price and trading time is trading price will give you almost all of the important turns, and not even the major ones, down to intermediate and minors. It will give you almost all the turns if you're trading price properly. The problem with that is it doesn't fill in the blanks in between those turns. And the point about time is it gives you, if you're trading time, it will give you an effective signal practically every day. And that's the big, big difference about trading time. If you look at this chart, not every one of these trades has been a winner by any means, but we've been with the market, with the trend, every single day. This is starts sometime back in December, and there has not been a time that the time cycles have ever been out of sync with this market. It's extraordinary, really, if you think about it. There's 1, 2, 3, 4, 5, 6, 7, 8, 10 buy signals, 1, 2, 3, 4, 5, 6, 7, 8, 9 sell signals, and that's taken us from December 17 to date through the whole quarter. And we're going to start testing this new trading program starting on Tuesday, and there will be an opportunity for you to have a look at it as it's testing. It's taken, as I say, over 2 years to get it working, and interestingly, it's not perfect, and it's never going to be perfect. Machines at this stage, we can't code them, or the people that work for me can't code them in to do all the things we do with a trader's eye. In other words, we can't get a machine to replicate what years and years of experience will do with eyeballing the market. So there are some of the studies involved that we use in trading time. Those of you who are doing or have done a tutorial will know what I'm talking about when I say that some of the tools we use can't be programmed because they're 90% science but 10% art. And it's the fact that the little part of them is art that stops them being programmed. That's a good thing, because the quickest way to lose your IP is to program it. Once it's programmed, anyone can stick a data stick into a machine that's running the program, and out it goes, off with the wind. So you mean the aesthetic? Yes, Manish, thank you. I mean the aesthetic sense, quite right. So this issue of trading time, we've been working on this program for a long time. We're going to start testing it next week. So as we get that set up and running, you'll be able to have a look at it and start to get a feel for it. But this is basically how it works. The next chart shows you swing trading on time signals. And you can see that there's a couple of sell signals that failed. They were valid sell signals. They met all the criteria for valid sell signal. They were elected, and then they failed. But you can also see that you have far, far fewer trades. You've only got 3 buys and 5 sells, as opposed to 3 times that in the everyday signals. And we're going to be releasing a program for this swing trading as well. It's very interesting for people who like swing trading in terms of being less active in the market, quite happy to have markets move against them for a certain degree. It's a far more laid back, less intense form of trading, and we think we're getting very good results on swing trading using time signals alone. And the time signals are creating an absolute standalone group of signals. Again, I repeat to you, this is not as good as learning to trade time. No machine can compensate for the human eye and brain. You're not better. The machine can't match my personal trading. Let me put it to you that way. And it won't be able to match the personal trading of anyone who's done a Daniel Code time trading tutorial. But it's the next best thing. Okay, the differences are significant. All right, here are the flyers, just looking at Forex, folks. On the back of this huge weakness of the US dollar, which I guess is going to continue as policy. I see no reason they'd change it. You can see that the flyers that are running off the weak US dollar are the Aussie and the Canadian looting. They've been quite dynamic, those markets. You Forex traders, make sure you're having a look at those and don't miss out on them. Okay, if we take our longer term hat on, this is a 12-day chart of the S&P. You can see, if you step back far enough and look at this, that all we're actually having at the moment is a correction. This market on the 12-day chart is still holding above one standard deviation above the mean. And that's a very bullish level. Just follow this through. I'll put the little highlighter on it so you can see what I mean. Here it is, spotlight they call it. This blue line, the thicker blue line, is the median. Look at this, is first one standard deviation above it, there. Then you've got this great long run all through here. All of this is one standard deviation from the mean. And at the time that was all happening, that was pretty bullish. So after we've had this is a real blow off top into 3 standard deviations from the mean, where's it back to? 1 standard deviation from the mean, right there. Okay, and it's holding that at the moment. So this market is still strong. You can pontificate all you like about if it's the end of the bull market. To us, it doesn't matter because we get paid exactly the same when the market's going down as when it's going up. Futures pays exactly the same. The big difference for us is that because we're futures traders and we're much more short-term oriented, you know, we're typically trading 1 to 7, 1 to 8, 1 to 10 days. All of the the commentary you read about and hear is designed for stocks people, predominantly the big institutions and the hedge funds. And their model is that they gather the money in. Most of the guys who front those things are good salesmen. They get the money in and they get paid a percentage of that. That's their base earning. And then they go and buy a trading program from one of the big firms, no doubt, or they might have their own expertise to do it. But basically, they're locked into that program. They're not able to have discretion until the program reaches the limits that allow them. And those limits are pretty slow. That's why the vast majority of them didn't get that nice VIX-driven volatility sell-off that we've had. But for us, it's entirely different. We can be short long today and short tomorrow. That's no problem. That happens all the time. So bear in mind that because of the instruments we trade, we're far more flexible than the institutional traders. Okay, let me go back to my normal tool and see what's on the next one. This is another one of those S&P charts which you've been looking at, and this low that came on recently, Friday of last week, March the 23rd, this came exactly at a fifth seal line. Okay, it came from a high before the high, went through a swing low and hit the low of that bar. It looks a little bit, I think you can see it all right, hit the low of that bar almost exactly, very, very close to it. That's a standard fifth seal line. That's an angle. It has qualities of price and of time. and that low came on a 59 Daniel Code time cycle, and the low was around, it wasn't as accurate as we normally have, 2675 was the retracement number there, and the close was 2596. That's too far away, but the low, 2586, is front running. It's premature for it to turn there. The next number was 2581, but you can see what the market's done since then. It's just back and forth hitting that number again and again and again. And today, the low for this was 2601. Here's this bar right here, 2601 against the 2675. In other words, one tick variance. It's the market's way of saying, sorry, I missed it. I'll make up for it. I'll show you that I know where that number is, which it's done today. So this market is absolutely normal, apart from the fact the bars are bigger. Get rid of the commentary, get rid of the indecision caused by fear and enhanced risk, and welcome it. This is what we want. This is what volatility is. A couple of them are pretty nasty, aren't they? You know, the buy signal that got elected, the buy was for March the 26th, got elected. Boy, down it came the next day, and still more on Wednesday. Bit of relief today. That's volatility, and that's what you want for trading. So don't be frightened of this stuff. I have tried to demonstrate to you today that the most important of these markets in equities, which is the S&P, because it's the broadest market, it is the most reliable indicator of what equities are doing. The Dow, as you know, is a very narrow market. Nasdaq's a very specialized market. Russell's are sort of a detuned version of everything else, but the S&P is still the most dominant equities market, particularly from the point of view of analysis. And I hope I've demonstrated to you that this market is moving absolutely normally, just like it always does. It's making its turns where it should. It's hitting all the time cycles. The only difference is the risk on entry has got too large, and you can adjust that by using a fixed dollar stop. Okay, for those of you who are interested in doing a Daniel Code tutorial, which will predominantly teach you to trade time, if you are interested in doing a tutorial, shoot me an email with your place where you live, so I can work out the time cycle, so I'm not calling you in the middle of the night or too early in the morning. Let me have your phone number and country and location, and let me know that you're interested in doing a Daniel Code tutorial, which now 80% of it is on trading time, and I'll be more than happy to give you a call and discuss your trading and what you will learn from a Daniel Code time tutorial. Thank you, Michael. We look forward to teaching you. We've already got one bloke's got his hands up in the tutorial. He's already done a tutorial. Michael Pell, he came to New Zealand, to Waiheke Island. Free trials, folks, if you haven't already had a free trial, you're welcome to. If it's a long time since you've had a free trial and you'd like another one, you're welcome to. Just go to the Daniel Code website. You'll see a banner there saying free trials. Just hit that button, follow the prompts, and email your Daniel Code username to Terry at support@thedanielcode.com. He will switch on the whole of the website for you. You'll be able to see all of the daily TO3 plus signals, and you'll also be able to see the fourth and fifth seal for that 31-day free trial, which is quite extraordinary what's been happening with that. In addition, if you haven't already had a free trial with Trade Navigator, they are happy through us to offer also a 31-day free trial, which Terry can arrange for you as well. So there's no reason for you not to get started. I can tell you trading is the best life. If you learn how to trade, if you become good at it the Daniel Code way, you'll make an extraordinary amount of money, and you do it in your own time and your own place. It's just a wonderful way to make a very, very comfortable living. This is our compliance statement. I do want you to be aware that trading in futures and commodities and Forex is risky. There is a risk of loss, and the less you know, the bigger the risk. So I do implore you, don't start trading real money until you're really confident you know what you're doing. Preferably do a Daniel Code tutorial to make sure that you're in the upper rank of elite traders. Okay, that's us for the day, folks. We're finished. I'm happy to have had you with us. I know it's getting to Easter very shortly. And yes, Harold says, have a blessed resurrection Sunday, John, with your family. Absolutely. Today is Good Friday. It's nothing good about it. It's the day we remember the death and crucifixion of Jesus. The good part is he died for our sins. And of course, don't forget Resurrection Sundays, Harold calls it, or Easter Monday is the day we think about the Jesus rising 3 days from the crucifixion, his resurrection, and that's always a case of great joy for Christians. Harold, thanks for that message. I hope you didn't mind me reading it out to everyone, and that's great. John, thank you. Ray, thank you. MSN, thank you. All blessings. Thanks, my friends. Wonderful to have you here. Do enjoy your Easter, peaceful Easter. Don't forget to give a moment's thought to why this most important of the Christian holidays is happening. And as Harold says, I can't improve on it. Have a peaceful and blessed Easter. Bye-bye for now. See you in 2 weeks, folks. More great trading coming up. It never stops. Okay, thanks for being here. Bye-bye.